Yes, so it's approaching 4, so we'll get this talk started. Hey, I'm Bhargav, and this is Andrew Brook of Celerity Incorporated from New Jersey. And he's here to tell you about machines and markets and the great big world of automated trading.
Okay, thank you, Bhargav. All right, thank you. Okay, so one of the first things people usually ask me when they hear that I'm going to be giving a presentation on automated trading and just finance in general to an engineering audience, they ask, well, when you were a student, would you have gone to that presentation? And my answer was, well, no, I didn't think any of that stuff was interesting. And to be honest, when I was a student here, and it was, well, I guess it's actually going to be kind of a long time ago, I was really completely unaware that there was any technology used in finance. And I think that's a little bit different today. Maybe in a good way and maybe not in a good way. So I'll throw up, these are 3 headlines, and you might have thought I spent a lot of time looking for these, but it was probably about 15 minutes going out online and looking for just interesting things in the popular press about automated trading and people using computers on Wall Street. And a couple of things that kind of jump out. One is that they all sound pretty scary. The other thing that jumps out is that they sound like they might have something to do with computer science. I think the word algorithm is in there a couple of times, and market supercomputers, which is kind of scary because I don't think most people would actually talk about that as a supercomputer. And it was kind of interesting that some guy was making $400,000 a year as a programmer and was being offered 3 times that salary to go somewhere else. And it does sort of kind of catch your attention and say, okay, something kind of interesting must be going on. But what is it? It's kind of scary and it's kind of different. So is this the latest program trading system? Here's the funny thing. This isn't me trying to be silly. This is the Wall Street Journal. The Wall Street Journal actually put that image at the top of an article called "Rise of the Market Machines." It was basically their predictions that computers were going to just completely take over the jobs that humans had been doing in terms of trading, in terms of a lot of the sort of quantitative things that happen on Wall Street. This was not all that long ago, I guess a little over a year ago, June of 2009, so this is before the flash crash, but after the big financial crisis. And it's interesting because when you see someone or an organization that's usually fairly conservative, like the Wall Street Journal, putting a pretend robot from a movie on the front of their newspaper, it's kind of, on the front of a blog sponsored by that newspaper, it's kind of interesting. So what I'm going to try to do today, and this is, I guess I've got a little over an hour to do this, and I'm going to try to leave some time for Q&A. I'm going to try to give you some idea of, when people are talking about automated trading, what does it actually mean, and what does it mean from a business standpoint, but more interestingly, like what does it mean for somebody whose primary focus is on software. I'm going to give you some examples, and I'm not going to go into a huge amount of detail, and if anyone wants to come up afterwards and actually sort of talk through the math of some of these, I can certainly do that, but I want to give you just a kind of a sense of when people are talking about automated trading, what are they actually talking about? What are some of the nuts and bolts of it? And then really with the part that I really want to focus on is getting into, what makes the technology interesting? What about automated trading is interesting from somebody whose, real interest and passion is computer science? And finally, sort of where things are going, sort of some recent developments, where things seem to be going in the near future. And at the very end, of course, I'm going to have to put in a plug for my company. But we'll have lots of time to answer questions as well. So to start off with is a definition, and a little bit later I'm going to talk about lots of other things that are sort of like automated trading or other words that are used when people are talking about automated trading. But what I'm talking about is trading activity in which the critical decisions are being made by some sort of automated process, by a machine, by a computer program. And when I'm really focusing on the critical decisions part because computers get used pretty much everywhere, including lots of places that aren't particularly exciting. Your ATM machine is obviously computerized, but it's not making any interesting decisions. But the neat thing is that over the last sort of 10, 20 years, more and more of the really interesting decisions are being made in part or in whole by automated systems. So this covers a really broad range. This isn't just big investment banks with thousands of computers, but sometimes it is. Sometimes it's just a couple of guys in a room with an Excel spreadsheet, a market data plug-in. I've worked with someone quite recently. Their entire firm is 2 people. The one guy who calls himself the trader, but he has to say that because it was his money. And then he hired a guy who's the developer, and that's pretty much the entire company, and they're largely automated. On the other end of the scale, 10,000 core clusters are fairly common now. It's no longer something that you would have per firm. It's now per desk or per department. In the late 90s, when I started out, I sort of accidentally got into banking. There was a group that I worked with that had a 20-node cluster built on NextStep. And it was kind of interesting because it was completely homegrown, and they were in the process of sort of retiring it. And within 2 years, they had replaced it with something that had close to 10,000 nodes on x86 Linux. It ranges in terms of the size of the firm, like I said, from day traders up to big investment banks. The terminology gets tossed around very, very loosely in the press and gets tossed around very loosely in most conversations. People talk about a lot of things. People talk about high-frequency trading, where there's lots of trading. You're not holding positions for a long time. That's usually automated, mainly because it gets really, really tiring for a person to have to do that. People talk about proprietary trading, which really means you're trading on your own behalf. You're not trading on behalf of a client or a limited partner or something like that. But proprietary trading has been around for a long time. It is not necessarily automated. People talk about electronic trading or e-commerce in a trading context, and that is, can mean a lot of different things, but basically means that there's a computer involved in the process somewhere, but that doesn't always mean that the computer is doing the interesting stuff. People use lots of other terms that go into this, but they overlap in a number of different areas. And I think to sort of help understand what we're talking about, it's useful to talk about what is trading. Why do capital markets exist? Why would people be trading financial instruments in the first place? And fundamentally, they have really two purposes. One is that they're supposed to allocate capital, meaning someone has some excess and wants to find some place to put it that earns a return, and someone else has a need for capital and something that's going to produce something useful if they only had somebody to invest in it. The capital markets are supposed to find those two people and bring them together, and to do it very efficiently. Part of doing that efficiently means setting prices efficiently, figuring out what is the right price for Google stock. If the market is going to be funding projects that Google is working on, knowing at what price to make an equity investment in Google is pretty important. So the way that the markets actually work is not by having one giant computer that sort of figures this all out, but by having lots and lots of participants going in and making offers. Well, I'd be willing to buy at this price. I'd be willing to sell at that price. So traders participate in markets. They may be doing it to facilitate a transaction. They may be doing it to manage risk. They may be going in looking for an arbitrage opportunity. They may be taking a bet one way or another on something. But fundamentally, that's how the capital markets work. By the way, they've been working that way for a long time, long before there were computers. When I talk about automated trading systems, what I'm really talking about is a kind of real-time control system. So I'm talking about people building stuff on computers and software that takes a bunch of inputs. It can be market data, it can be news, it can be information about a bunch of different things, and turns it into actions that make sense in the market. So going out and buying a security, selling a security, publishing prices, executing orders, things like that. And like any other kind of an automated system, it operates according to rules. So somebody programs it ahead of time. In the sort of terminology you'll hear on the street, you'll hear people talk about strategies. And we'll get into that in just a minute. So you might sort of ask yourself, well, that sort of sounds like lots of different automated systems, and why would it be so scary? So in a lot of ways, automated trading systems are doing sort of the same things that human traders have done for several hundred years. But they're different in the sense that they have a capacity for much larger volumes of input data. So it's not limited by what one person can keep in their head at a time. It's much larger than that. Reaction times are much faster, and we'll talk about that a little bit later. They're complicated, and they're complicated enough that things that non-engineers could have understood 50 or 100 years ago, maybe even 10 years ago, are really starting to sort of stretch out of that realm. And there's a small note at the bottom. I don't know if anyone can read that. But the people who are having a hard time keeping up with this include bank executives, regulators, politicians, journalists, et cetera. And that has some kind of scary implications, because some of those people are supposed to be doing things related to that market that they might not be able to do because they fundamentally don't understand it. So there's kind of a little bit of a joke in here about automated trading isn't scary like nuclear weapons or flu pandemics or Google driving your car. But it's a big automated system, and if it breaks, it can be a really big deal. So maybe in that sense, maybe it is kind of like Google driving your car. It sounds really neat, and maybe it has some big advantages over what we would do today. Fundamentally, Google driving your car and you driving your car, might not be that much different. But if it's complicated and it breaks, it might cause trouble. So One of the things you heard me say earlier was that a lot of what automated trading is just doing what humans were doing for hundreds of years. Some of the themes that you hear talked about in great detail in the press are really not that new. People talk a lot about latency arbitrage. Somebody investing in some fancy new technology to get information from point A to point B just a little bit quicker than the next guy, and now he's got an advantage and he can do things that the other guy couldn't do. There's a nice story about a fellow named Paul Reuter. He eventually went on to form a information technology company that was involved in financial markets for many years and bears his name. He used this fancy new technology called a telegraph. Everybody else thought that carrier pigeons were really the way to go, and he ended up stringing some electrical cables from Paris to Berlin in 1851. All of a sudden, he can move information from Paris to Berlin several times faster than the guys who were relying on birds. The guys who were relying on birds were feeling really upset about this because they'd only fairly recently gotten their carrier pigeon system up and had just gotten good at beating the guys who were sending messages on horseback. So they were really upset that the telegraph came along, and there was actually, it's interesting, there are actually a fair number of articles written in the day about how that was really unfair and it was just really a bad idea to allow people to use telegraphs. Computers being blamed for stuff going horribly wrong in the financial services sector. The single largest stock market crash in percentage terms was the stock market crash of October of 1987. I don't know how many of you, some of you were definitely around at that time. I remember it very vaguely. I certainly wasn't working at that time. I was still in grade school. But this was probably not the first occurrence, but it was certainly the first where when you do a Google search on headlines going back a few decades, this one pops up all the time. So that's definitely not a new thing. Some things really are new, though. There's this interesting concept of real-time social news streams. So people using things like Twitter to talk about what's actually happening in real time. That before, this would have been a journalist's job to do that. A lot of the basic fundamental rules of journalism. You always check your facts before you say something. That inherently makes you a lot slower than a guy who just tweets something out because he saw it. Well, if you're trying to trade off the value of speed versus accuracy, sometimes you really want to wait until a proper journalist tells you that something happened, and sometimes maybe you want to listen to Twitter. So that's definitely having an impact. It's changing who reports news, and that has a big impact on financial markets. Another is there's just the fundamental understanding of markets. People have this idea of the efficient market hypothesis. If any of you guys are actually economists in the room, feel free to put your hand up, and then you can walk out because I'll probably say this all wrong. But the efficient market hypothesis basically says, well, everything that is knowable about the market takes in more or less instantaneously. The prices all adjust, and everything happens efficiently, which means there's no free lunches, there's no arbitrage available. That was an interesting idea that, over the last sort of 15 or 20 years has been challenged with a lot of empirical studies that say that humans don't necessarily behave rationally, which is one of the assumptions built into the efficient market hypothesis. So there's this whole field of behavioral economics saying that people might do things for completely irrational reasons, and that might do interesting things to the market. The second is saying that, information doesn't get processed instantaneously, it doesn't move around instantaneously. Therefore, when new information becomes known to the market, prices don't adjust instantly. There is some lag time, and the way that the market reacts to that actually follows some sort of adaptive or evolutionary track rather than sort of instantaneously getting to the right state. So there's definitely some interesting ideas that people have about how markets behave. Some of those will have implications when you try to build systems that are automated. And finally, Moore's Law keeps on delivering. I remember as a freshman in computer science, very active speculation about whether processing power per CPU was about to hit a wall, and they said by 1997, we're kind of expecting it to plateau. Oddly enough, that didn't happen. At the time, people were telling me, yeah, but they said that in 1982. So the interesting thing about Moore's Law is that every few years, things are running about twice as fast, and the cost per unit of computation goes down. And in the short run, it just means that we do everything the same way we did before, but we just do it faster. In the long run, we end up finding radically new ways of doing things. So every once in a while, that has a big change. So you're probably getting some idea that some of this might be relevant to CS. I'll give you a few more examples. One is that financial services, this was something that I did not expect and really hadn't thought about when I was a student here. And I sort of accidentally got into finance, which is a whole other story I can talk about some other time. But when I got into finance, I was really surprised at the number of programmers that I was seeing, the number of people I was seeing talking about hardware and software. And I asked somebody, I said, wow, this is kind of kind of a shock. And they said, well, why would that be a shock? Financial services is fundamentally an information business. There is no fixed good that we're producing and selling out on the street corner. It's all about moving information from one place to another. Almost anything that happens in finance is fundamentally a computation. And so people who are good at it are people who can do computation faster and more accurately. So, you kind of should expect to see a lot of computer science people around. But it's been accelerating over the last 10 years. So that to the extent that when you go into a number of different kinds of financial services companies, 10 years ago you would have seen a balance between people who had non-computer science, quantitative backgrounds, math or physics, something like that. You would have seen people with financial or business backgrounds, and you would have seen people with engineering backgrounds. The skew is now in many, many firms that the engineering, people with engineering backgrounds are now by far the largest part of the actual staff in terms of just number of people. It's not unusual to find some of the smaller financial services firms, particularly on the buy side, so meaning hedge funds and proprietary trading firms, those who are engaged almost exclusively just on the active trading, to be 2/3 or 3/4 technical staff. One of the interesting side effects of that is that over time, some of those technical people, some of those people with an engineering background end up in management, and then all of a sudden, the ideas about how you ought to run a company sort of start to change. And it's an interesting environment in which in certain roles, you can actually figure out, so this person's contribution, we actually know how much that was worth. That person actually made this much money for the firm. And you end up finding that sometimes people end up getting paid a substantial fraction of the value that they earned for the firm. And you all of a sudden see compensation in certain areas that's dramatically different than you would see in other industries. And that can be kind of confusing. Financial services has had a big impact on the technology itself. So 10 gigabit Ethernet, the general purpose GPU concepts, low latency WAN links are all areas that have either been directly driven by needs in financial services or where financial services has been a large fraction of the market that the people who are building these technologies hope to sell to. And the last area that I think is actually the most interesting is that there are starting to be a lot of really interesting practical applications for artificial intelligence. Financial services is a very data-rich environment. Lots of inputs and outputs that are already in electronic form, already in machine-readable form. So you're not so worried about having to, teach your robot how to see things and how to sense the environment. And the environment that it's operating in is already coming in electronically. And there are a lot of examples where people have successfully used machine learning, natural language processing, neural networks, et cetera, around for some of these systems. So earlier I was telling you about sort of what an automated trading system is. It's something that's taking these actions based on on software. It's following a set of rules or strategy, and to have some idea of what this means, I want to talk about a couple of different common strategies. Give you some flavor of what people are actually trying to do with this. So I'm going to talk about something called a VWAP. It's a volume weighted average price. It's a strategy that that a broker would execute on behalf of a client to minimize market price impact when the client wants to either buy or sell a large number of securities. I'll talk about one example of an arbitrage. I'll give you an example about market making, which is where someone is going out and offering to buy and sell something with a difference between that buy and sell price. And finally, the concept of event trading. So taking information in about things that happen in the real world and then trying to make a decision quickly before the rest of the market reacts to it. So I'm not going to go into a huge amount of detail on these. I'm going to leave the slides up in case anyone wants to see them later. I'll go through sort of quickly. If anyone has questions later or wants to go through an actual quantitative example, I can do this. But volume-weighted average price, the basic concept is let's imagine someone wants to sell a large number of shares of Microsoft. If they were to go and submit a big order to sell a big chunk of Microsoft shares, and send that as one big order to the exchange, the net result would be two things. A whole bunch of, some part of that order would execute immediately based on whatever bids were on the exchange already. The rest would sit on the exchange because the rest of the bids would have already been matched. It would wait for people to submit new bids. The net result was that you would execute a lot of it quite a ways from the price of the best bid in the market. And the reaction of the market would very likely be that the price would fall sharply before the rest of your order got executed. So an alternative is, rather than sending it all as one giant chunk, if you don't think that the market price is really moving in any particular direction, you just send it through as little piece by little piece, and you try to weight it based on how much activity is going on in the market. So the net result is that you end up executing at sort of a weighted average of the price of the market over time, and it's weighted by the amount of volume that was happening at that time, hence the name. Technically, it's fairly straightforward. You really just want to make sure that it works exactly the way that you've advertised, because you've built this system for the purpose of allowing your client to execute something. You're executing it on their behalf, and they're going to have certain expectations of exactly how it worked and how you're going to be able to audit it. The risk to the client, obviously, is that the market price moves substantially during this time period. Then they're obviously exposed to that. Here's a second example. This is a form of statistical arbitrage. So basic idea is you find two assets whose prices are correlated. So two things, you could look at, say, the stock price of Intel and AMD might move in a way that's highly correlated because things that affect one might affect the other. The idea is you watch those, you find two things that are correlated, you watch them, and whenever one goes up and one goes down, the one that goes up, you sell, the one that goes down, you buy, that they eventually come back together. That's based on the assumption that those two things really are fundamentally correlated for some reason, and that over time they are going to track together. It's a strategy that doesn't gain or lose any money if the two move together, or if the market as a whole moves up or down. What it does do is it tends to make money for you when something pings one of them, and then very shortly thereafter, the other one catches up, where there's a time lag between the information being processed around one of those two securities. So as a general rule, it's relatively low risk, but it's the big challenge is you have to process really, really large amounts of data. You have to find these things, and then you have to be able to get in fairly quickly. As soon as you find that here's an example of two things that are correlated, and one of them just sort of went out of alignment, and you have to know when to be able to get back out again if it looks like the fundamental correlation is broken down. And you make very, very small profit margins off of each one of these trades. So you want to be able to execute very large numbers of these things, and you want to be able to do it very efficiently. Hence the reason that this is not usually done by people, but rather by machines. Another example is something called market making. The concept of market making is pretty simple. It's just anybody who goes in and says, there's a market for some asset. I'm going to be willing to buy it, and I'm also willing to sell it. Obviously not at the same price, but I'm willing to sell some asset for 90 cents, and I'm willing to buy it at 80 cents. So if what that means is you're providing a service to anybody else who comes in. Someone else comes in and says, well, I'm just fundamentally interested in selling. So what's the price that you'd be willing to buy it? Oh, I'd be willing to buy it at 80. Someone else comes in and says, well, I've got more of this than I need. I'd like to get rid of it. What price would somebody be willing to buy it? Someone's willing to buy it at 90. Great. The difference is that you make the difference between the 80 cents and the 90 cents. The advantage or the benefits to the broader market is that people who have a fundamental interest in buying or selling something. Think about commodity markets. Farmers are fundamentally people who want to sell the corn. People who make food are fundamentally people who want to go out and buy corn. Having a market maker in there constantly putting out both a price that they're willing to buy and a price they're willing to sell means that there's always somebody willing to buy. The market always runs nice and smoothly and efficiently. The risk to the person who is the market maker is you go out and say, well, here's the price I'm willing to buy or sell. Somebody sells, and then no one else wants to come in and buy. And then someone else wants to sell, and then someone else wants to sell. There's no one else that, you're stuck now owning quite a lot of it at the same time the price is falling. So it's incumbent on the market maker to have some idea of what the behavior of the market is and be ready to anticipate price movements in the market and not get surprised by outside events or things like that would move the market price substantially. So there's also engineering risks in terms of if the system is slow, then you have a substantial risk that you've made a price at, you're willing to buy at 80, willing to sell at 90. Someone else says, the market price has already moved down quite a bit. I'm going to be willing to buy at 50 and sell at 60. Someone else can go and say, wait a second, I can just buy from you at 60 and sell to you at 80. Now you're stuck owning something at a price substantially higher than the rest of the market. Last one, and this is kind of an interesting one, and this is something that we're seeing more and more of, and so I'll go into this again a little bit later, is the idea of actually doing event trading. So sort of the exact opposite of what the last couple of strategies we're talking about, where you want to avoid events, you want to know about events when they happen, so you can sort of stay out of the market when they're happening. Event trading is the exact opposite. It's anticipating when certain events will happen or finding out very quickly when certain events happen and doing something about it. So here's an example. You start off by finding some kind of event that either you can predict when it's going to occur, that's the easiest, or you have some way of getting notified really quickly about something that's unexpected. So here's an example of one that's scheduled. Apple publishes their iPhone sales quantity, how many iPhones they sell each quarter. Yeah, and obviously, if they sell lots and lots of iPhones, you can expect there's going to be the Apple stock price will go up. If they don't sell very many, the stock price would go down. So you go out and you say, well, the current Apple stock price seems to factor in about 7.5 million iPhones sold. When the actual event occurs, you find out that Apple's iPhone sales were actually 8.4 million, substantially above what everybody expected. That means go out and buy Apple stock. Now, obviously, this, in principle, sounds really, really simple. The devil is sort of in the fact that you have to be a little bit faster than the next guy. You obviously have to have more accurate data. So if two people are competing at the same strategy, whoever gets the information first wins. So I'm going to stop just for a second to ask if there are any questions about the sort of the business part of this before we launch into the technical part. Questions? Go ahead. It depends on the market. In some markets, there is an explicit obligation. The market maker must always be willing to buy or sell the asset. And obviously, sometimes that comes with certain privileges, but it also comes with some obligations. In other markets, there's no fundamental obligation. People can come in and be a market maker on Monday and then decide on Tuesday, I don't want to. Or they can be a market maker right up until the point where it looks like things are going kind of crazy and, okay, I don't want to be a market maker anymore. Oh, absolutely. Yeah, well, the example that I just gave right there, what if, word leaked out early, but it was completely wrong, that Apple's iPhone sales were actually going to fall short of the expectation of 7.5 million. Yeah, absolutely. That's kind of a hard problem. It's kind of like having a protocol around preventing people from spreading rumors. You can say that, yeah, so acting on it is a little bit different in the sense that if you act on a rumor and it's right, then there's a benefit to you. If you act on a rumor and it's wrong, then there's a loss to you. So it's, the risk that you would take on by acting on a rumor should be an incentive for you to try to figure out whether it was correct or not. So that puts the burden on you, the person who's acting on this rumor, to make a judgment as to how reliable do you think the source is, how accurate do you think the information is. But in terms of a process for preventing people from trading on rumors or taking action on rumors, even in any other context, it's probably a little bit broader of a problem than that. Okay, so let's talk about some of the technical issues, and this is the part that, to be honest, is a little more exciting. So there's a whole bunch of different issues with trying to build systems that are going to be automated and are going to handle these sorts of problems. One is latency. So latency, just the time from when your input comes in until you have to send out your output. This is an area that, several of the examples I gave before, it should be pretty obvious that if you can get to the answer quicker than the next guy, you may have an advantage. Now, there's an interesting corollary to that says, if a whole bunch of market participants can get to the answer quicker, the market as a whole prices information in more quickly and operates more efficiently. So there may be a net benefit to this overall, but for the individual, this means you need to be quick. And the definition of quick has changed a lot over the last few years and is still moving. Some of these are specific numbers from firms where I used to work or firms where I have some insider knowledge of. Foreign exchange, a client sending in a request saying, I'd like to know at what price you'd be willing to buy or sell British pounds, and expecting to get a response back. In 2003, I worked on a system where we were basically told, if you can get an answer back out, it's a web front end, get an answer back out in about a second, that's probably pretty cool. Because today people have to call on the phone, and if they could do it in 1 second on the web, that'd be great. Not all that long ago, I worked at a similar firm where the expectation was that answer had to go out very reliably in under 5 milliseconds, and they were in the process of designing the next generation that by now, I don't work there anymore, but by now should be sub 1 millisecond. Equity order execution is at a major broker where I have a good friend who works. In 2006, their expectation, if somebody submitted an order to that broker, the time before they would have to turn around and send them back a reply saying, yes, it was filled, or no, it wasn't filled. 10 milliseconds seemed pretty reasonable. They're in the process of getting ready to go live with an upgrade of a system that should come out at the beginning of this year, where that goes to 5 microseconds. It's currently around 20 or 30 microseconds today. So those sorts of numbers are kind of interesting. They're interesting from a computer science standpoint because things that algorithmically are pretty straightforward if you have, a tenth of a second or something like that to get the work done. You can really just kind of think about, okay, is it, order n, is it order, log n? You can think about it in very general terms. When you get down into things that are down in the hundreds of microseconds, you need to worry about, okay, is the thread that's going to run this, is it even getting scheduled at the time when the input data arrives? You have to worry about things happening at the hardware level. You have to think about things around memory allocation. It stops being so much a problem of, well, is my design going to scale from 100 pieces of input to 200 pieces of input? The question is, are there going to be things that occur one time out of 100 that mean that my algorithm doesn't even run for 2 or 3 milliseconds, and I completely blow through my 100 microsecond window? A lot of the development tools don't have a lot of precision around timing. So you go into you switch on your debugger and you want to step through a particular loop and see, why is it every once in a while it takes, 150 microseconds just to go through this one section of my code. Hopping through a debugger and getting your debugger to come back and tell you that, yeah, this is the part that's going to take 15 microseconds, this part will take 20, that turns out to be fairly hard. Just the operation of actually sampling the time off the system clock at each one of those points ends up taking a lot of time and ends up messing up your results. Even figuring out how much time has elapsed between two things, or finding out, particularly when you start worrying about distributed systems, how much time has elapsed here, and I send a message here, and then what time is it, and I send a message back, how much time has gone by. PC hardware in general, and actually a lot of commodity server hardware, is not designed to maintain time at those sorts of precisions. And it ends up becoming pretty complicated. And finally, what this means is that, in terms of measuring time, everything becomes local. It's very, very hard to have very consistent timestamps across a whole bunch of processes running a bunch of servers, so that I can say, oh, well, I'll just look at the timestamps to see this operation occurred and then this operation occurred. You often can't do that. If you want to know that this operation occurred first and therefore might have affected this one across two different machines, you can't look at the timestamps. You end up having to actually say, okay, I compute something, I pass it over, I then display, yeah, I received this token or this, transaction ID. The other thing is that a lot of design patterns, a lot of concepts, a lot of off-the-shelf software that's optimized for high throughput. You want to have low average computation per unit of useful work that comes out. Often those don't work very well for low latency. Low latency, you may be perfectly willing to sacrifice a fair amount of efficiency to make sure that you had all your computation sort of pre-staged so that when the event occurs, you can get your answer out really quickly. Volume is another one. Typical market data feeds, and even these numbers are getting to be probably almost 2 years old. So somewhere in the 1 to 10 million messages per second is now going to be kind of an old number. This is probably getting closer to the 10 to 100 million messages per second. This gives you a lot of problems. If you're trying to write something that's where you're avoiding things like context switching, and you've got a multi-core CPU, and you've got one core just busy spinning, listening to a single socket, pulling data off the wire that's coming in at pretty close to the full capacity of a 10 gigabit pipe, you end up finding that even running a single thread in a tight loop on a single core might not be able to pull the data off the wire quick enough. And you say, oh, well, I'll just run several threads on several cores. Well, no, you end up with the context switching and the time that it takes to move data from one core to another often end up swamping that. So it's interesting that the hardware limits in terms of how much information can be moved from one core to another and how quickly you can pull things off of a network card and bring it into into the kernel or into user memory is running right around the barrier of the sort of volumes of data that are actually seen in the real world. Interestingly enough, if you talk to some of the engineers from Intel, I had some interesting chats with them a couple years ago, and then again at the career fair yesterday. A lot of the design decisions that went into the Nehalem microarchitecture were designed around ways of getting large amounts of data between cores at very high speeds, in a large part because they had a lot of customers who were buying tens of thousands of cores to do stuff along these lines. Now, there's obviously, market data is not the only sort of data that we're worried about. The web, Twitter, are at very, very similar scales in terms of absolute volumes of data. As a general rule, they're not as latency sensitive. People don't usually care about an extra 5 milliseconds of lag in getting a tweet or getting a Foursquare update or their web page downloading. That's slowly changing. There are more and more demands on real-time web and social media. All right. So one of the common ways that people start looking at how do I solve this problem? I've got piles and piles of data, and I want to get through it really quickly. What do I do? My CPUs aren't a million times faster than they were 2 years ago, so I'm going to just have to go out and buy a million cores and try to run everything in parallel. So you see a lot of development in multi-core CPUs, general-purpose GPUs, clusters, clouds, sort of ranging all the way up from the very tight hardware coupling all the way up to the very loose but very wide. One of the interesting things is that although the general concept of parallelism is pretty widely deployed, you don't see any, there's really no silver bullet. You see a lot of, common patterns, but you don't see any one approach. Everyone says, oh, well, we're going to do everything with general purpose GPUs, because that works great for some things and not so great for others. This is a very active area of development as well in terms of the quality of development tools, compilers, languages, everything else. There's some interesting work going on here, interesting work going on at places like Intel around this. One of my favorites, distributed real-time systems. I'll give you one example, and this is from a real system, although the numbers have been moved around a little bit. So imagine you've built a system and you want to, client is trading through your system, and to manage risk, you've told your client, the net of how much you've bought and how much you've sold can never be more than plus or minus 25 million. So we're going to set a hard limit at 25 million. We want to be able to enforce that on a global basis. The client is, a large business that's, spread across the world. And the places they're going to be physically submitting those trades are spread out across the world. So, you imagine, New York, London, Tokyo, pick some large cities. And the client expects a response in under 5 milliseconds when they submit a request to one of those sites saying, I want to buy this much, I want to sell this much. They want to get an answer back in 5 milliseconds. But the speed of light is not something that we can adjust in this question. So you run into a problem that, the client submits an order in New York. They've used up, 5 million of their $25 million limit. They submit an order in New York saying, I want to buy 15. Well, should you say yes or no? Well, the problem is that what if at right about the same time they submitted a similar order in Tokyo saying, I also want to buy about 20 in Tokyo? Well, either one of those in isolation you would say yes to, but if you say yes to both, then they're going to be way through their limit. The problem is that you can't send a message from New York to Tokyo and get it back in time to be able to tell the guy in New York, like, whoa, no, he's executing something in Tokyo. This makes a really neat interview question. So in case if you ever interview at Celerity, pretend that you didn't read this. The side effect is that coming up with a good general solution to this problem turns out to be really hard. You end up having to relax one of the constraints. You either say, well, we're going to allow people to go through their limit once in a while, but if we see them go through their limit, then we get really angry at them and tell them they shouldn't have done that. Or you could say, well, they're never going to go through their limit, but we might reject sometimes when we could have said yes, because we're going to take that big $25 million limit, split up into little tiny limits to all the different locations. Obviously not very efficient if you have a client who, once in a while executes in Tokyo, but mostly executes in New York and wants to do very large trades. You're going to be telling him no all the time, and eventually he'll go trade somewhere else. We can relax the part about saying that you have to give a response in 5 milliseconds and say, well, maybe we'll give you 500 milliseconds and see if that's okay. Or we can go faster than the speed of light. If anyone has any suggestions there, let me know afterwards. Synchronization. This is another neat one. This is one that has some interesting regulatory implications. So regulators in general, they want public companies to disclose anything that they consider material information. Material meaning somebody who is making a trading decision might change their decision if they knew about that information. So this is the big headline financial news, like Intel beats its earnings estimates. It can be little tiny things like, oh, by the way, we got sued by some small company for patent infringement, and we might lose. So the regulators say, well, everybody, all investors, should learn about this information simultaneously. Simultaneously, if you are a regulator who is assuming that most of the people that your regulation is meant to benefit are going to get their information from the newspaper and they call their broker the next morning and place a trade, then simultaneous within a few hours is probably good enough. And a lot of the regulations that govern these things came out during the mid-30s. During the mid-30s, you had a few people who had the telegraphs and the little ticker tape machines that would sort of print stuff out. But the people didn't have the internet. If a lot of the people who are making investment decisions in the market are making decisions based on information that's available in milliseconds, and they're making execution decisions in microseconds, then even delivering your information a few milliseconds different at different points around the world is in some sense inherently unfair. Now, measuring things, down to more than a few milliseconds starts to get tricky. I mean, NTP with some tuning, you can get it down into the milliseconds. GPS with commodity hardware, 10 microseconds is probably fairly reasonable, but starts to get a little bit more expensive. You even start to get into like the definition of delivery. Well, does that mean when the data actually crossed into your network, it had to cross into everyone's network at the same time, but some guys then, process the data a little bit quicker? Or the data arrived at everybody at the same time, but some people got it in the form of a PDF and some people got it in the form of a CSV. Exactly, do you sort of measure it when people actually made the decision? Well, but that sort of means that people who are thinking faster are, in some way, acting unfairly. It turns out that at very low latency, at very high speeds, the concept of fair delivery starts to get really, really murky. And yet these are sorts of the things, these are the sort of things that regulators are supposed to be dealing with right now because they're inherently part of the market. Reliability is a fun one. If you're a participant in a competitive market, the whole point is that you are actively trying to do something that is not in the interests of one of the other participants in the market. If you're the first person to get to that order, well, then somebody else wasn't the first person anymore. So we sort of jokingly say, yeah, they are out to get you. So the whole point is you're trying to build stuff that's going to be faster than the next guy. And in a lot of cases, you want to have development cycles where things get turned around in hours or days or weeks rather than months or years. Now, from the standpoint of a software developer, this is a lot of fun. It means you actually get to write code and you actually get to test it out and you get to see it running in a very short period of time. If you go into a lot of other industries, you work on a project that may take months or years before it's done. You may have moved on to a different department before the thing goes live. It's exciting, but at the same time, it can be very nerve-wracking because you know that if something goes wrong, it's I think you guys saw from the very first slide, it was something like 5 seconds to lose a little over $1 million. And that's by no means an isolated case. That's fairly common. If something blows up, it tends to get expensive really quickly. It's not just that you lose a lot of money. To some extent, people will price that in, saying, well, look, we're going to make this much money over time. We're just going to have to figure that it'll blow up once in a while. Even money aside, you have enough of these big blow-ups, you start getting attention from regulators. This could be reputational damage depending on who you are. I'm going to talk a little bit about hardware infrastructure failure. That's probably the easier one to deal with. You can just buy lots of different things, design your architectures to be hot, spread everything out, make everything run in parallel in such a way that your data is a shared nothing architecture where everything can operate independently. Your strategies for how you do your sharding, how you do your failover, all of that. You can work your way around most types of hardware failures. Logical failures are a lot harder to deal with. If somebody fundamentally designs their algorithm wrong, you can think about, well, I'll run the system in a test environment. I'll run it against historical data. Historical data is great because you can't fudge it. It is something that actually happens, so it's inherently a reasonable set of data. The problem is that historical data doesn't catch things that haven't ever happened but might happen to you tomorrow. The testing infrastructure often ends up being more complicated than the stuff that you're actually building. Building something that can replicate a real-world trading environment is pretty complicated. The answer that you end up finding is you usually see a combination of different things. You see people looking at doing a lot of deeply embedded unit testing. You see big investments in large end-to-end automated testing systems. But you also see a big emphasis on hiring people who understand how the algorithm works and can actually look at it and say, yes, that's actually correct, or no, there's a bug in there, without having to run through all the possible combinations of input. There's a whole other discussion that we could get into, which is that who has responsibility for doing the testing? Now, obviously, if you're working at a firm whose business is based on their ability to make these decisions accurately and reliably, your business is going to depend on doing this sort of stuff correctly. You're going to take steps to try to do it right. You're going to balance off, well, it'll cost me this much to build a test environment, but if I don't, here's my potential loss, so I'm going to balance out that way. The problem is that particularly when you get to be above a certain size, if you screw up and your system falls over, that can have larger implications for the broader financial services sector, it can have broader implications for the economy. I think 2 years ago, if I had presented this slide, people would have said, yeah, it's kind of not a big deal. I think it's a little bit different now. I think it's sort of a baked-in assumption now. So it sort of implies that there may be an obligation on the part of your regulator to say, if you're building something that's this big and this complicated and this many things depend on it, maybe you should have a way of testing it. that meet certain standards. The problem is that you try to balance it against the that first bullet point that says you also want to get it done in a matter of days or weeks because you're reacting to what the other guy is doing. So that's kind of a hard thing to plan around. Okay, so I'm going to talk a little bit about future directions. So I hope I presented some of the things that are going on that are kind of interesting, some of the things that have happened over the last couple of years that are relevant for somebody who's either in a software or hardware side of computation. Now I want to talk about some of the things that are going on in the future, and by future, some of this is stuff that's happening right now and is sort of just coming out, and some of it's a little bit further out. But let's start off with hardware. Everyone's going to be shocked when I tell you that hardware gets faster, smaller, and cheaper every year. No? No one's surprised? Okay. Yeah, hardware gets faster, smaller, and cheaper every year. One of the things that you might not expect, though, is that as computational challenges get more interesting, people who are looking at doing things more cheaply tend to move up the stack. So things that used to be done in hardware, we'll just do it in general purpose hardware instead of custom. Well, now we'll do it in software instead of in general purpose hardware. People who are looking at pushing the performance envelope tend to go the opposite direction. Well, we used to just do this in software, but it wasn't quite fast enough. So now we're going to actually try to do this, throw out the Java, do it in C++ or assembler. All right, forget C++ and assembler. We're going to have put this on an FPGA. Okay, FPGA is not working. We're going to have to design some custom silicon for that. It's interesting to see certain areas within the financial services technology stack moving down into the hardware. There's a company called Arista Networks that makes these really neat switches, and you think of a switch as being something that sort of takes in, a packet, look at the MAC address, look at the header, pop it out the other port. You think, okay, well, something is, so the next layer up would be looking at IP addresses, looking at routing tables, and figuring out where it goes. Arista's built a switch that at the bottom layer is custom hardware that's moving stuff from an input port to an output port and does it in something like 600 nanoseconds. But the next layer up that actually controls the ASICs is basically just a Linux kernel with a whole bunch of information going through sysdb. So, it actually becomes fairly straightforward for you to write your own module that goes in and says, any packet that comes in that meets this sort of a pattern in its header, I actually want to take that off the fast path and move on the slow path because I actually want to take the payload and transform it and then put it back out over the wire. So all of a sudden you can build some really neat stuff that's very close to the hardware layer, get some of the advantages of the speed that you would get by having custom ASICs for anything that could be passed straight through, anything that you had to actually bring back up the stack you could bring up. We're seeing lots of cases of people encoding fairly sophisticated logic in FPGAs. So taking a field programmable gate array and saying, well, instead of just doing if this value is this, then I'm going to want to do one of the following outputs. They're actually taking some fairly complex decisions. And one firm that I know of has actually implemented a translation for a subset of the Java language into the instructions needed to program the FPGA. So their developers are actually writing their business logic in Java, in a subset of Java. So it's fairly straightforward. They can look at it and they kind of see how it works. And then they sort of hand that off. That goes through something akin to a compilation step. And that's actually what's responsible for that 5 microsecond response time on order execution for one of the brokers that I mentioned. Last is some really interesting hacks that we've seen done for network interface card firmware. The firmware is really supposed to be doing things like making decisions about which packets to actually bring onto the card, and occasionally doing things around rewriting headers and making decisions about how to move, which stuff gets moved up into kernel space and which stuff gets moved up into user space. We've seen examples of people taking that firmware and actually moving some of the actual business logic. Like, okay, I get this input message. If it meets these criteria, I'm actually going to construct a completely new packet that represents an order and send it out. So you don't actually move anything up into the kernel itself. And the last is general purpose GPUs. The CUDA library in particular have been used extensively for certain analytical problems. It hasn't really moved into the low latency space just because the memory, the path to get from the network interface card onto the main CPU, onto the GPU, and then back again right now is a bottleneck. There's some interesting development going on that would shortcut some of that and may make general purpose GPU useful for things that are very latency constrained. But it's not there yet. Cloud computing gets a lot of attention. 2010, I would say, I guess people could argue about this, but I would say this is the year that cloud computing started getting significant commercial traction, at least in the financial services space. It's definitely, obviously very scalable. The APIs are sufficiently mature for real use. How many people out here have deployed something on a cloud? EC2, Amazon's S3, any of those? 2, 3, 4 hands. You'll probably find that even if you were to go out into a corporate job today, there's a decent chance that you'll be finding people making active use of cloud, and almost every company that does computation at some scale is doing fairly serious investigation of this. In terms of people who are building automated trading systems, places that have demand profiles where they're extremely spiky, meaning it's pretty quiet most of the time, and then 2 or 3 hours a day it gets 10 or 100 times more busier. Those people are using cloud. We're just beginning to see some discussion within the cloud computing community. There's a couple of announcements over the last couple of months from Amazon in particular around how to make, how to deploy latency-sensitive applications into the cloud, where you start to have some control over, okay, I want to make sure that if I deploy 10 compute nodes, that they're all going to be within a certain distance of each other in terms of the network topology, or I'll make sure that they have a high bandwidth connection between them. There's still a lot of issues to be resolved, regulatory and security being just 2 of those. Long term, it's kind of neat to look at cloud computing as a leveler, in the sense that it used to be that in order to be a participant in high-performance automated trading, you had to have the resources of a large firm. More and more, we're seeing firms. I mean, I gave the example of one particular firm that I know of that has 2 people on staff. We're starting to see more and more examples of people where the entire firm is really quite small, and yet is able to compete in some of these very computationally intense areas. Cloud computing is certainly one of the important enablers there. And then the last area I want to talk about is collaborative and social. Remember what I said earlier about financial markets really fundamentally in some ways being a process for aggregating a whole bunch of information and doing some form of computation on it. In the case of taking a bunch of information and figuring out, based on all these people saying they want to buy and sell, what does that mean the asset price ought to be? What's the right asset price that balances all the people buying and all the people selling? The social media, and we'll start with social media. There are a lot of new kinds of information besides just buy and sell that are available electronically and are being aggregated and pulled together. So you get concepts like sentiment. So how many people think Coke is awesome, and how many people are really angry about Coke? That sort of information is going. You can find that by mining blogs. Facebook's little thumb up. I like this thing. There's a lot of real-world events that have impact on markets. The traditional news services have been around for a long time. You can get your feed from AP about everything an AP journalist says is interesting or important. But all of a sudden now there's people posting about stuff on Twitter. There have been several examples. The Haiti earthquake and the earthquake in Chile were both posted first on Twitter. If you want to look back and see where was the first electronic notification that was available in the public domain, it wasn't the AP, it was Twitter. Now the interesting thing is that if you said, oh, well, great, well, I could use Twitter to find out about earthquakes. Now it turns out there are several soccer teams called the Earthquakes, and people use it in lots of different contexts, so Twitter's not particularly well structured for that sort of thing. But fundamentally, the information is there. At some point, someone's going to figure out a way of mining that. The news company should probably be a little bit worried. Social graphs. There's a lot of information available on things like LinkedIn or Facebook to say how are people related. That obviously has impact on things. Where things physically happen. Try to imagine something really, really important that would be really impactful that's going to happen where there are no people with cell phones around. It's getting harder and harder to imagine something happening that somebody isn't going to have a fairly high-end cell phone that would be capable of saying, that might be a valuable thing for the rest of the world to know about, and type it in. There are also some really neat techniques for taking the input of large crowds of people and pulling out valuable, high-quality information. Twitter is not an example of this. Twitter is an example of pulling in lots of information, the vast majority of which is completely useless. But Wikipedia is a great example of taking the input from a whole bunch of different people and producing something that's arguably of at least the same level of quality of the thing that it replaced. So the financial markets are very actively looking at all the different things that I listed above. There are people looking at how are we going to take sentiment information off of Facebook and use that to make determinants about, Gap Jeans just introduced a new product, a new version of their some line of clothing. Is it going to take off? Is this going to be a big contributor to their bottom line? Likewise, the ability to publish news information in real time over something like Twitter. Now, the next generation is not just pulling information in and sort of mining and harvesting that information. The next generation is allowing people to sort of actively contribute and not just contributing with sort of a central news agency, but contributing and collaborating with each other. So that's a space that you'll definitely want to watch. And then semantic web and AI. So I'll give you, so this is sort of a silly example in some ways, but in some ways maybe not so silly. I'll explain in a second. So automated trading systems today, the most interesting ones that I've seen either have very complex mathematical models, but they're inherently sort of single operations. So take all these inputs, the correct price is a function of the following 15 inputs, and it can be expressed as a single equation. Or it's a system of rules, but the depth of the rules, the depth of the trees that you're going through is really fairly shallow. But you can sort of imagine people saying, well, there was heavy rain in Illinois during the corn harvest. That's a piece of news. Well, you could sort of logically reason your way through to say, well, heavy rain during a harvest is probably going to lower yields. Well, if there's yields are lower, then there's less corn. It means the price of corn should go up. Corn's used as a feed to cattle, therefore the price of beef might also go up as a result. Beef is a big input for a burger restaurant, therefore we should really be selling McDonald's stock. Now, there's 1, 2, 3, 4, 5 or 6 levels of sort of logical reasoning. There's obviously a lot more than that would go into some analysis like this. And you sort of laugh and chuckle and say, okay, that's probably a little bit out there. The funny thing is that this is what human traders do. This is not, if you go into somebody, okay, maybe 5 or 6 steps is a little bit extreme, but this is not for a human, this is not an unreasonable sort of chain of logical inference to go through. I sat next to the special situations desk for several years at Morgan Stanley, and that was their job, was to sort of figure out how weird things happening in one part of the world would change the prices of certain other assets. There was an alleged sighting of a submarine that belonged to a certain country off the shore of another country. That news hit CNN, and the first thing they said is, okay, well, what is that going to do to sovereign debt prices for those countries? Well, but okay, if that happens, what is that going to do to the value of the stock of the banks that hold that sovereign debt? Okay, well, what do we work your way 2 or 3 levels out, and then try to make a trade based on that, where you're substantially ahead of the next guy. So the idea of having machines able to make that sort of logical inferences is a few steps further out, but you can already start to see where some of the different pieces of that come in. If you have the news in real time, the news is properly tagged. You have things like Wikipedia, but are more defined in a way that would make sense in terms of having a formal ontology. The ability to work your way into something where this could be automated or partially automated is maybe not that much of a stretch. So in terms of sort of wrapping up, I wanted to give you guys a sense of what automated trading is. And the only thing you should probably take away, if you want to have a 1-sentence answer, is it's kind of like machines doing what people used to do, but just a lot faster. Like any new technology, there are lots of challenges. There are lots of ways that it can go right, and there are lots of ways it can go wrong. And so it's maybe not unreasonable to expect the Wall Street Journal to put a picture of a fictional, large, scary robot at the head of their blog. But at the same time, that maybe that's a little bit more hype than it needs to be. But most importantly, it's driving a lot of technology innovation, high-performance computing, artificial intelligence, several other areas. These are things that should be of interest if you're studying computer science. If these things are interesting to you, this may be a career area to look at, or at the very least something that you'd want to be aware of. So finally, as I promised, there will be a shameless plug for Celerity. And you might be wondering to yourself, well, why is any of this stuff interesting to me? Well, besides being sort of academically interesting, I happen to work for a company that delivers real-time event data. We use some interesting AI techniques to take data from real-time unstructured sources, web pages, press releases, things like that, pull out very specific pieces of factual information that we know are valuable to our clients, and deliver them as quick as we can. So we're a 2-year-old startup. We're well-funded. We have paying clients. We launched our first product about a year ago in a private beta. We made that a public beta starting in March of this year, aimed at primarily the financial services community, although we're doing some work in the traditional journalism space as well. And we have some very exciting products under development that are going into beta in the next 2 weeks with existing clients, and that you will probably be hearing something about in the first quarter of next year. And the reason I am down here on campus is because we're looking to hire lots of software engineers, interns, co-ops, full-time, et cetera. So if you're interested, come and talk to me. Okay, plug's done. We'll go back to Q&A. Any questions?
What exchanges or countries do you expect to start allowing electronic high-frequency trading in the next few years? Outside of the States, and
Okay.
I guess London and Tokyo.
Right. So there's a couple of different ways to answer that. The first is you could almost I'll try to rephrase it. I'll state the question again, which is what countries would allow high-frequency trading on their exchanges. The short answer would be, will any countries actively prevent high-frequency trading because it's available? It is actively participated in quite a large number of countries. The cases where someone would not be able to trade with a machine would generally be those where their stock exchanges are not automated, where they're still on paper. And that's becoming more and more rare. So outside of sub-Saharan Africa and some parts of Central Asia and a few parts of Latin America, it's already electronic. And where it's electronic, some of the participants are using machines to make their trading decisions. Now, different exchanges will execute orders at different speeds, and will execute them according to different rules. It's very difficult to imagine how you would set up a regulation that said, well, you can't use a machine to submit an order, but the order comes in electronically. How would you prove that there was a human on the other end? Coming up with like sort of a Turing test equivalent for something that sends in a buy or sell order is kind of hard to do. The other way of answering your question is to look at which countries are making active investments in upgrading their technology infrastructure for their exchanges to be able to execute orders more quickly and to be able to execute orders at higher volume. There's very active competition right now between a number of countries to upgrade their exchange infrastructure. The Economist ran an article sometime earlier this summer, maybe it was June or July, particularly talking about how the country of Singapore was upgrading its national exchange to be able to execute orders in an average of 90 microseconds. The NASDAQ is currently around 170 microseconds. So there are several countries that are actively looking to leapfrog the U.S. in terms of being an easier environment on which to do high-frequency trading.
I have a quick follow-up question. So what are the barriers for, say, traders here to trade on those new markets?
There aren't usually. They very actively do trade on those markets. I think there's one on the other side, Bhairav.
Earlier this year, Google very quietly put out job postings for essentially high-frequency traders, and presumably both Facebook and Twitter will also start capitalizing on their information advantage, since they have that information before anyone else does, and that probably applies a lot more to Facebook than it does to Google or Twitter. So as a smaller company that doesn't have that information edge, how do you prepare to compete with that?
They definitely have information edge in certain areas. It's not exactly clear what areas they have an information edge in and which ones they don't. They have a big advantage in terms of access to a very large volume of information. Take an example of something, some event happens in the real world, and its relevance to somebody who's trading something. How does that information how does that information sort of spread out? Now, you're right that somebody like a Google or a Twitter may find out about that information fairly early on. Their infrastructure today is really not optimized around making decisions quickly. They're capturing huge amounts of information, but they're not updating in milliseconds or microseconds. Would they be able to do that? That's certainly a possibility. They don't, at the moment, have a monopoly on the originating sources of information. One of the nice things about the web is that, yes, Google may crawl the entire web and may build a really nice index of it, but if I know that some information is going to become available on somebody's web server at some point in time, I'm not really at a huge disadvantage compared to Google in terms of my ability to pull that information down from that web server as soon as it becomes available. In some ways, if Google is trying to pull information from the entire web, and I really just want to hit one website, in some ways I've got a big advantage. I can, with a much, much smaller investment in infrastructure, I can just hit that website at pretty high speed. Google can't do that to the entire web. So I'm not completely convinced that the obvious advantages that someone like a Google or a Facebook would have would translate into a huge advantage in terms of being able to run some sort of an automated trading strategy. It's going to be interesting to watch.
How do you try to convince your clients that your software produces good market decisions?
Okay, so our software doesn't actually produce market decisions. Our software doesn't tell someone to buy or to sell. Our software is just reporting information. So I'll give you an example. You gave the example of Google. A couple days ago, Google reported their quarterly earnings. They reported it by putting a big press release up on their website. And that press release is several pages of human text and some tables and some other stuff, talking about all sorts of different numbers. Buried within there, a couple of numbers are really relevant. Revenue, earnings per share, things like that. What our software does is, as soon as Google posts that information on their website, we pull that down. We run a natural language processing algorithm across it. It pulls up the sentences, looks at the grammar, based on some machine learning techniques off of historical documents. We know these phrases are typically used, to denote certain things. We pull out the revenue and we tell our clients, okay, Google's revenue was this much. So we're not saying you should buy or sell it. All we're saying is, rather than processing this big document, we'll just give you sort of the Cliff Notes version of it. It says, the revenue is this much. Now, the way that, sorry? I would have to look that up, but it's typically, for something like Google, it's typically in the order of like 50, 60 milliseconds. It ends up, depending, the NLP part of it ends up not being the dominant time. Getting it down off their web server often is a dominant time. That ends up being a kind of a long discussion. But sorry, your question was, how do I convince my clients that my information is accurate? By and large, by saying, well, I'll hook you up for a few months, and then at the end of a few months, you can pay me, or we'll turn you back off again. And they'll compare our data to the data that's produced. We have a number of competitors. Somebody lost their electricity here. Subtle hint, I guess. Basically, we'll say, feel free to compare us against someone else. They'll take in some competitors' feed, whatever it is they've built in-house that may have been doing this before they bought it from us. And if our data comes in as more accurate and comes in faster, then they'll usually come around and say, okay, yeah, we want to sign up. If they turn around and say, no, the stuff we already built in-house is faster, then they won't. We've built up a very nice track record of winning, though.
Can you elaborate again a little bit on the usage of the cloud in the future direction, sort of the technical side?
Okay, sure. So probably the single biggest benefit of the cloud, and I don't think this is very controversial, is that it gives you the ability to very, very rapidly take advantage of a huge amount of computing resource, and then when you're done, you can sort of give it all back, and you don't have to pay for it for the rest of the day. In businesses where demand for computational capacity is highly variable. So it's very, very quiet, and then right at a certain time, right when the market opens, boo, there's a big spike, and then it's quiet again. Then right when the market closes, there's a big spike, and maybe at the end of the month, there's a big spike. Cloud computing is a great way to be able to build an infrastructure that can scale up really fast and scale down without having to pay a whole bunch of money up front just to buy as many servers as your maximum need. So in terms of the benefits of cloud, it's really easy to sell somebody on why that might be valuable. I mean, anybody who has to pay for sort of the budget for the capital expenditures for their hardware immediately looks at this and says, oh, great, I'll sign up. The major barriers are, for people who are doing some of the stuff that we're doing, is latency is probably the biggest one. I don't know physically where that machine is, and I don't know what the quality of the network is, which means, whereas, in one of my data centers, I physically, rack the servers, and I know where, here's my patch panel, comes in from the client for the cross connect, hops down. This is, 10 gigabit Ethernet, hops down into the network interface card. I'm going to intentionally set this up so that I can have the shortest possible path from this server to this server and then back out again to the client. And I have a lot of control over that. It's kind of scary being in a small company because you can be the CTO and the guy who plugs in the cables at the same time. The downsides, for the cloud, when I go out and start off an EC2 instance, I'm vaguely aware that it's somewhere in Northern Virginia. And I can run diagnostics. I run also trace routing ping and things like that, and I say, yeah, it looks like they've got their network set up pretty well, but I don't have any guarantee that it'll work well. It may not work quite as well as I could have done it if I were optimizing it myself. So that means that for certain applications, they still stay in my core network, in my own hardware. But for certain applications where maybe an extra 20, 30 milliseconds on inbound and outbound doesn't matter, great, I can sort of toss it up there. Similar problems around security. Certain countries have restrictions on saying, well, if you hold private information or public information that's valuable in some way, there may be privacy rules saying that you have to legally state, I know the machine that stuff is on, and I'm responsible for it. Well, obviously, if I'm outsourcing this to Amazon, and Amazon won't be willing to, sign a contract that says that, then I can't use it. So it may limit which information, the stuff that's public or the stuff that I derive that isn't, controlled by a privacy rule, I can put on the cloud. Names and credit card numbers and things like that, maybe I can.
Following the flash crash, a lot of, or at least the public seem to blame automatic trading for the flash crash.
Yep.
So do you think automatic trading is to blame for that? And do you have like a personal opinion of what caused the flash crash?
It's an interesting one because it highlighted, the flash crash back in May highlighted a couple of interesting things. One was the degree to which the news media really didn't know how any of this stuff worked. It was the first time that a lot of traditional journalists sort of got introduced to the concept. And you kind of read the articles starting in May and going until more recently. And in May, they were all, we don't know what's going on. And then the much more recent ones, there have been some articles put out in the popular press that were actually very, very well informed, or at least in comparison to the ones in May. To some extent, this was an automated system, and it failed. So somewhere along the way, some form of automation didn't work. Now, whether this was someone's trading strategy not working, whether someone's trading strategy working, but they didn't really intend it to do that, whether this was a human error that was then amplified by the fact that it was then automated and repeated a certain number of times. It's interesting that the findings from the investigation that went into this generally came out being much more sort of vague and saying, well, it's kind of a little bit of this and kind of a little bit of that. It really wasn't. It wasn't the high-frequency trading that people had originally assumed was part of the problem. But at the same time, it certainly came back and said, well, even if it wasn't the cause of this one, there's certainly ways that it could fail that we could imagine that could cause something at least as bad. And the other thing is that, it came out in May, and I think the first report from the commission that was studying it only came out, 3 weeks ago? It gives you some sense of how much data you have to go through just to figure out what happened in a 2 or 3 hour window. The tools available to regulators to go in after the fact, sort of, the way that guys go in after an airplane crashes and they pull together all the pieces and they figure out, they bolt the black box and they kind of piece together what happened and what went wrong and what we should do to prevent it in the future. There doesn't seem to be that level of maturity around the financial markets. It seems to take months. At the end, they kind of scratch it and say, well, we kind of think it might have been this, but we're not really sure.
You had mentioned an example in the for eventual consistency where there was a lag allowed in the time that the values were sent back. So is there also sometimes a tolerance for values? For example, you mentioned $25 million, but is the tolerance around $25 million?
There certainly could be. So one way you could imagine solving that problem is imagine you had 3 different trading sites, and you don't want anyone, you don't want them to go over $25 million globally, but you might put in a tolerance and say, well, how could I make sure I always accepted an order that would be under the 25 million global cap, and but still kept some sort of a limit on? Well, one way to do it is to put a $25 million cap at each site, and then have some process after the fact. So, on each site, you could, in theory, go up to $75 million over by simultaneously submitting orders in all 3. But have some process that after the fact is exchanging messages to try to figure out where the aggregate actually gets to, and then have to process again after the fact that comes back and says, hey, you're really over your limit. We're not going to let you put in any more buy orders until you've sold off some of the stuff that you already have. That's absolutely a reasonable technical solution. The question that you might ask is, well, does that solve the underlying business problem? Why does somebody want a $25 million global limit? Is it potentially because some signal, some event occurs, and all of a sudden clients at all three sites simultaneously say, oh crap, and they start selling as fast as they can? If that's the case, it's going to trigger your $25 million limit, then the solution that we just described isn't going to be a $25 million limit. It's going to be a $75 million limit, and you're going to hit the $75 million limit if something bad ever happens. So maybe in that scenario, maybe it's really not a good enough solution. The other problem with that solution is it doesn't scale very well. You start off with 3 sites, so 3 times 25 is 75. Okay, that kind of makes me nervous, and maybe not so bad. But what if it's 20 sites? Okay, that's actually a lot of money, and maybe I'm really not comfortable with all of a sudden 20 times 25 million being the sort of the aggregate, theoretical upper limit. But you're exactly right. Those are exactly the sorts of trade-offs that somebody who's designing a system like that would want to go through.
You mentioned that you guys are using the AI technologies in your production, in your softwares to extract information from the web, and you gave a specific example that you extract some numbers or some information from the web page. I mean, but that's still some very shallow AI technology like MLP to just process it.
Yep.
Do you provide any deeper reasoning component in your software? I mean,
reasoning. Sorry, was that the question? Is do we go beyond just sort of entity abstraction or value?
Yes, I'm interested in what's the state of the art in the production system in your industry.
Today, for the stuff that we're working on, we're really only going down to the level of saying, I want to be able to answer certain very straightforward questions. What was Google's revenue for the 3rd quarter of 2010? Oh, it was so many $1 billion, right? So I have enough semantic structure to say, okay, I know the entity Google, I know the period of 3rd quarter 2010, because in the document they're going to talk about, well, unlike our 2nd quarter revenue, which was X, our 3rd quarter revenue was blah, so you can't just look for the word revenue. And I need to know about sort of the things of, there may be domain-specific information around, like we talk about earnings per share. There's adjusted earnings per share and GAAP earnings per share and various exclusions. And so it can get a little bit more complicated, but fundamentally we're still just saying, this value, this property has the value X, this value has the property Y. Going the next step and trying to do reasoning beyond that, we're not doing that yet. We have some clients who I have some indication are doing a little bit of that today. Remember, they have a harder decision than we do. We're just saying, okay, this document came out. Can I make some very explicit statements about what information is contained in it? Whereas my clients are taking that information and making a much harder decision, which is, okay, is that a good enough reason that I should buy the stock or sell the stock? Which might take into account a lot of other things.
Well, what about analyzing tone in the document? Are the forward projections positive or negative? That is rather straightforward, but it's not.
So the quantitative aspect of forward-looking projections. So it's common, for example, taking earnings as an example. It's common for an earnings announcement to contain forward-looking information. To say, 2 quarters ago, Intel made a big projection about how their earnings for this quarter would be lower than they had originally stated. And they gave very specific numbers. They said, originally we thought our revenues would be this, and then now our revenues are going to be this, or maybe it's either earnings or revenues. That sort of very quantitative, very specific thing, absolutely. That's actually a very big part of our product today. Tone, or more general things like, does the document sound positive? Are they generally happy about this? There is a lot of activity in the industry right now around collecting sentiment. Broadly, people talk about this as sentiment. So, looking at a document and saying, here's an article that was written about the new flavor of soda produced by Coca-Cola. It's generally a positive review or a negative review. Or some guy just tweeted, this new kind of soda stinks. I can't stand it. There are companies that try to take that information, sense the tone, aggregate it together and say, oh, look, the new iPhone 4 is a big hit. Everybody likes it. Or no, the new iPhone 4, everyone's really pissed off, and particularly about this keyword around antennas. We don't know exactly what that means, but something about antennas and being very negative keeps coming up. That can be really useful. It's hard to quantify. It's a lot easier to get tripped up. There's some really neat examples in the literature and some of the marketing material that's being produced by a few companies in this space around how they differentiate between, what was an example? This product has never been better, which is really very strongly positive, and yet you have to do a fairly good parse of that. This product has never been better, or this product has never been better than mediocre. Makes a big difference, right? So at the moment, we don't do anything around sentiment. The other thing is we've had feedback from clients saying, we're not really sure what we would do with sentiment if you gave it to us. If you tell us, this was their earnings and this is what we expected, yeah, we kind of know how we turn that into a decision. If you just tell us that people are sort of vaguely not happy with Apple right now, like we're not sure that we would buy or sell based on that. It could very well be something important in the future, though.
When you tell your clients something like, this is Google's revenue this year, or earnings per share, how do you convince the client that your extraction of entities and relations is good?
Well, after the fact, it becomes really easy. All this is all public information, so they can go right to the website, within seconds, pull it up, look at the number on the website, look at the number we sent them, and yeah, either you were right or you were wrong. It's very much, every once in a while we get into something that's a little bit fuzzy. You get some of these things where in the document they'll say the company was happy to have earned over $3 billion this quarter. And then a table in the document says their earnings were $2.99 billion. And people say, well, you guys reported 3, and it was really 2.99. Okay, well, yeah, that's kind of, splitting hairs. But broadly speaking, the data that we produce is very factually verifiable and typically very quickly after the fact. As part of our service, we go back and we check with the original source. We would call the investor relations desk, or we would speak to one of the major media organizations or something like that, and go back and verify that the numbers we put out were in fact the correct numbers. But there's, it's a fairly trivial exercise, at least in isolated cases. It might be a little bit harder when you do it across the whole scale of all the things we're doing. But all the information is public. We're not producing any information that's top secret. We're just producing in a way that's able for someone to take into an automated system a little bit quicker.
Just a follow-up question. What I asked was more about the NLP part of it.
Okay.
It's almost certain that the documents can have text in ways that are really hard to parse.
Mm-hmm. Yep.
So it might be the case that so there's something like Google's earnings per share is so much, or Google's earnings per share was so much last year, and it has gone up 3 times this year.
There are absolutely ways that it can fail. We don't produce 100% accuracy. Right now, our precision, so precision and recall, precision number is a little bit over 99%. So when we produce a number, our failure rates are below 1%. Of the numbers that were in the document, we've tuned our algorithms to intentionally say, well, if we're not really sure, we just don't say anything. So our recall number is around 95%, but it depends on the types of sources we're looking at. It varies substantially between different sources. But you're absolutely right. At the point where we send the client the number, they're really, if we are inherently the first one who sent them that information, there's nobody they can check with without waiting to know whether our number was right. And there really isn't anything we can tell them at the time that we send it out that we're more or less confident. We could try to put something kind of fuzzy in there and say, yeah, this looks like a pattern we've seen before, so we're really confident, or this is a pattern we haven't seen before, so we're not as confident. But as a general rule, if we weren't really confident, we probably wouldn't have sent it anyway. Our clients are kind of in the same position that we are, that in order to judge whether something is likely to be correct or not, they mainly look at our historical accuracy. So when a client signs up, they'll sign up and they'll watch our data for some period of time before they'll decide whether to start using it. They may also ask that we send them, historical copies of, over the prior year, send me all the data you gave about the following 10 companies. They'll look back and say, okay, well, yeah, okay, you were right all the times except for that one. So, yeah, you're probably, X% probability of being correct. that's inherently a predicting about the future, assuming it'll be sort of like the past, and it breaks down in certain cases. Most of our clients, if they're actively participating in trading, they're used to the idea that it's not always going to go the way they expected it to go. And so they're very comfortable with the idea of, okay, if I have a data source that's going to be correct, 99% of the time, how do I want to structure my trade so that I can manage that risk? The 1% time that I'm wrong, I don't lose so much that I offset the stuff that I made when I was right. That also, though, suggests that that might not be an appropriate thing for someone to do if they weren't comfortable dealing with those sorts of risks and trade-offs.
I was wondering, to what extent do customer requests drive sort of the development of your services?
In an aggregate sense, almost completely. One of the things about being a small company is that we can't really afford to go out and build something if we're not sure if someone wants it. That's fairly risky. So to a large extent, if customers, when we're thinking about building something, we go to our customers and say, would this be valuable to you? Sometimes we'll go so far as to say, if we built this and we charge this much, would you want it? And they know that if they say no, we might not build it. Whereas if they say yes and it's not something they want, they might end up overpaying for it. At the same time, though, we don't generally take explicit requests from any one customer. We don't do custom development on behalf of one customer. So we're still fundamentally building a single product that's a single data feed that we send out to all of our customers. But there have been a number of cases where customers will come to us and say, the way that you report earnings per share is really more nuanced than what you're doing. Do you think you could sort of fine-tune it, sort of slice this earnings per share concept and actually break it out into different pieces? And we said, okay, it's an interesting idea. We go to several other customers and say, we're thinking about doing this. Would it work for you? And several other customers said, yeah, that'd be great. So we did. But there have been other things where we've had one customer say, well, I'd really love it if you could do X. And all the other customers say, no, that's useless. And we say, well, unless this one guy's willing to pay for the cost of development, then we're not going to do it. We're quite a ways over our time, so I'll be around here for another 15 or 20 minutes if people want to talk or have questions. Other than that, I think they're probably already serving food, so I'm amazed this many people stayed. Thanks.